Let's talk inventory. What is inventory? Why is inventory so important to everybody? And why did the International Accounting Standards Board actually bother to write a statement, IS2, only pertaining to inventory? Now, what do we want to achieve by doing this study unit? Number one, you must be able to define inventory. What is inventory? What do we actually consider to be inventory? You must also be able to correctly calculate the inventory amounts. So what is the cost of inventory? How are we going to value inventory? So there are different cost formulas that we can follow. So how are we going to value inventory? There's something that we call net realizable value. You must be able to know what is net realizable value, and you must be able to apply the net realizable value test at the end of the financial year. You must know that there are different inventory practices and methodologies. A company or entity can either have a periodic inventory system or it can have a perpetual inventory system. You should be able to know the difference between the two. We are busy with financial accounting, guys, and financial accounting is all about disclosure in financial statements. So therefore, IS2 is very prescriptive. How exactly should inventory be disclosed in a set of financial statements? What happens if there are inventory losses? How should we account for inventory losses? How are we going to calculate what the loss is all about? And then how are we going to record the inventory loss? And then when we go to insurance claims on inventory losses, you should be able to apply the averaging clause, and you should be able to do journals when we lodge an insurance claim with an entity. Now let's go to IS2. IS2 says, well, number one, inventory is an asset, and that asset's been held for sale in the normal course of business. So that is trading stock. Or that asset can be in the process of production. Now, if you think about a manufacturing environment, let's say we make furniture. What is our raw material? What do we use in order to make that furniture? Let's assume we make tables and chairs. Then obviously wood would be our raw material. So we need to convert that wood into a final product, which is then going to be our inventory item. Now, so that is also an asset which can be in the form of material, raw material, i.e. the wood, or supplies. So if I'm just buying and selling furniture, so I buy the finished product from whatever factory, and I'm going to sell the finished product. So I've got nothing to do with the production process. Then I'm buying the supply. So then I'm going to buy and sell. Guys, why is inventory so important? Why do we want to do inventory? Why do we say that inventory, you can always expect an inventory question, whether you're in accounting, whether you're doing tax, whether you're doing auditing, and MAC is all about inventory and manufacturing and inventory valuations. So, why is inventory so very, very, very important? Just think about that. Can an entity exist without inventory? No, it can't, because inventory is actually what it's all about. He buys inventory items in order to sell inventory items, hopefully at a higher price than what he paid when he bought those items, so that he can make a profit. And that is what any company or entity is all about. We want to make profit. And how do you make profit? By selling a product at a higher cost than what you have paid in order to acquire that inventory item. Now, if I just buy the finished product, then obviously it's an easy computation. I must just add a certain profit percentage to the cost price of the goods in order to derive at the selling price. When I'm actually the manufacturer of that product, eventually I want to sell that product, but it's a little bit more complex to get to the cost of that item, because I have to accumulate all the different costs involved in order to manufacture that item. So that then will make up the cost of the item. So we have touched on that, and we will look at this when we do manufacturing accounts again. What is finished goods? What is work in process? What is raw materials? And then what is consumables? So you must know about these things at this point of time, but it will become clearer as we go along and do manufacturing accounts. Now, one type of asset can be an inventory item for one type of business, and it can be a non-current asset for another type of business. If you think about, for instance, a motor dealer, what those motor cars standing on the floor, that is his inventory. That is the commodity that he buys and sells. But if you think about somebody else, let's say a garden service, that's a stupid example in any event, but let's say a garden service, that guy needs a little bucket that he drives around with all his garden stuff on at the back. So that motor vehicle that he uses in order to go from garden to garden, in order to perform this service, that to him is a non-current asset. So for the one, it is a commodity that he trades in. For the other one, it's an asset that he uses in order to be able to conduct his business. Let's have a look. What is the procedures for measurement of inventory? Now, how are we going to determine what the cost price of an inventory item is? Because we have to show that inventory at cost in our books. Now, obviously, when we buy a finished product, so we're going to buy the dining room suite and we're going to sell the dining room suite. Then obviously the cost price of that dining room suite is what we're going to pay the supplier of that dining room suite for that specific dining room set. Now, if we don't have the means to go and collect that dining room suite or suites from the supplier, and we have to pay somebody to go and deliver and pick it up from the supplier and deliver that item at our premises, that delivery cost I have to incur in order to get that dining room suite in my possession in order to enable me to sell that dining room suite. So, IS2 says the cost price of an inventory item is not only the purchase cost of that inventory item. He says the purchasing cost of that inventory item is the main component of the cost. He says, but all other costs that you have incurred in order to get that item into your possession and to enable you to use that item for the purpose it was acquired for, all those costs must be capitalized as part of the cost price of this asset. So this inventory item. So this delivery cost that you've paid an external party in order to go and fetch that dining room suite from the supplier and come and deliver it at your premises. If I don't pay that guy that cost, can I sell that dining room suite? No, I can't, because it's not even on my floor. So how can I sell something that is not on my floor? So let's see what purchase cost then all entails. The purchase cost entails the purchase cost. If I'm going to import that item from overseas, I'm going to pay import taxes. Now that import taxes is part of the purchase cost. If I do not pay the import tax, I cannot get the item in my possession and therefore I cannot use the item. All other non-claimable levies needs to be capitalized as the purchase cost of this item. Now, what is a claimable levy? Guys, a claimable levy is, for instance, VAT. If I am a VAT vendor and I can claim the VAT back as input VAT when I purchase a stock item from the receiver of revenue, the VAT portion, then it means I can claim the VAT portion back. Therefore, I cannot capitalize the VAT on the invoice, the purchase invoice of the inventory item. I cannot capitalize that input VAT because I'm going to claim it back from the receiver of revenue as input tax. So all other levies that you're going to pay, doesn't matter what is the type of levy, but as soon as I can claim back that levy from a third party, I am not allowed to capitalize that as part of the cost of an item. And it makes perfectly sense. I can only capitalize a cost which came out of my own pocket. If I can claim something back, it didn't come out of my own pocket. I was reimbursed for that specific amount. All the carriage and handling cost associated with receiving that item, of getting that item into my possession in order for me to use that item for the purpose it was acquired for, all those costs needs to be capitalized. Now, what about discounts? We have done things like trade discounts, we've done things like settlement discounts. Where does that come into play? Well, a trade discount is a specially negotiated price. So obviously a trade discount will be already being accounted for in the purchase cost of the item. A trade discount does not appear on an invoice either because the invoice is made up or out for the amount after the trade discount has been taken off already. So trade discounts is not included in purchase cost because it has never been included in the purchase cost. Once I have negotiated the trade discount, I've negotiated the special price and therefore it's not part of the purchase cost. What about the settlement discount? Now, a settlement discount is a different animal. A settlement discount is a discount that I'm going to receive if I'm going to pay my supplier within a certain period of time. So if I'm going to pay my client, let's say his settlement terms are 5, 15, and 30, then it means if I'm going to pay him within 15 days after the date of invoice, I'm going to get a 5% settlement discount. So a settlement discount means I did not at the end of the day pay the invoice amount. So the cost price of this asset, the cost price of this inventory item that I've acquired will then exclude the settlement discount. The settlement discount didn't come out of my pocket. I never paid that. So I cannot inflate the cost of an inventory item by not deducting the settlement discounts that I've received. And the same thing applies to any rebates or subsidies that I've received when I want to purchase any inventory item. Now, again, conversion costs we're going to talk about when we get to manufacturing accounts. I'm not going to talk about that at this point of time. Now, there are certain costs that's excluded according to IAS 2 that you are not allowed to capitalize. Now, abnormal waste is something that you're going to work with when we do manufacturing. So forget that one for the moment, just park it. Storage costs. Now, storage costs, for your purposes, you are not allowed to capitalize. Now, there is an exception. IAS 2 says, yeah, you can capitalize storage costs if that storage cost is incurred because it is needed as part of the production process. So let's say, for instance, I've got a huge manufacturing plant and I need to put a lot of the stock in the production process, but it takes up a lot of space. So somewhere along the line, I incur storage costs, but those goods has already been issued into the production process, and that storage cost is a necessary cost in order for me to continue with my production process. Now, if that is the case, then I am allowed to capitalize storage costs. But for your purposes, I will not ask you that. So I will ask you, if I give you storage costs, it will not be a necessary expense, so therefore you will not be able to capitalize that as part of the cost price of an inventory item. Now, any admin overhead that does not attribute to bringing the inventory to its current location and condition cannot be capitalized. Now, if you think about training costs, let's say I buy highly technically advanced type of equipment. So obviously what I would like to do is I would want to train my sales personnel on what this equipment can do and how does it work and what is the benefits, etc., etc., etc. But it's very highly complicated, so they have to be trained first before they can actually talk and sell this product to an outside party. And I'm going to incur certain training costs if I'm going to train my people in order to sell that product. Now, those training costs of my staff members is specifically excluded. I'm not allowed to capitalize that at all. Let's say that I have now a new product that I want to launch. So I'm buying this new product, I have a huge party, I invite all my customers or all the important customers, my main customers, in order to introduce this new product line to my new customers. And it's costing me a pretty penny because this is quite an elaborate event in order to entertain them. Now the cost, that promotional cost, that it's actually an advertising cost or entertaining cost, whatever you want to call it. I'm not allowed to capitalize that cost as part of the cost price of an inventory item either. Obviously, a selling cost can never be capitalized as part of a cost price of an item. I usually catch you out there. I give you freight charges in or freight charges out. So freight charges on purchases and freight charges on sales. And then you merely go along and you capitalize the freight charges on the sales. Freight charges on purchases has got to do with getting that inventory item in my possession and to enable me to use that inventory item for the purpose it was acquired for. So therefore, I must capitalize the freight charges on purchases. But the freight charges on sales is a sales-related cost. It's got absolutely nothing to do with getting the inventory in my possession. It's getting the inventory into the possession of the client. So therefore, those costs, you are not allowed. Any sales-related cost, you are not allowed to capitalize as part of the cost price of an inventory item. I've spoken about VAT, but what if I am not a VAT vendor and I'm going to buy from a VAT vendor? Can I claim the VAT back then? No, I can't because I am not registered for VAT. Although I'm going to buy from a VAT vendor and he's obliged to issue a VAT invoice to me for the goods that he sold to me, so on the invoice, that purchase invoice that I'm going to get from him, I will get the VAT exclusive and the VAT inclusive amount. Now, because I cannot claim the VAT back from the receiver of revenue, what am I going to do with the VAT? Now, in that case, the VAT will be capitalized as part of the cost price of the item because I cannot claim it back. Now, I'm not going to talk about fixed production costs. That's got everything to do with manufacturing. So we are not talking about manufacturing at this point of time. What do we show as the cost price of inventory in the statement of financial position? Now, according to IS2, we have to show inventory at the lower of cost or net realizable value. Now, we've spoken a lot now, what is the cost price of an item? The next question is then, what is the net realizable value of an item? Now, the net realizable value, just look at the words, net realizable value. Let's start from the back. Value means what is its worth. Realizable means what can I get if I sell that? If I realize something, I sell something. So what can I get if I sell something? And this something that I'm talking about is obviously the inventory item that we're talking about. Net, why do we put the word net in front of the realizable? That means that I have to do some kind of computation because a gross amount would be what is the gross sales value of the inventory item on hand? What can I get if I sell that inventory item tomorrow? That is what realizable means. Net means maybe I should have done a little calculation because before I derived at the gross realizable value. And that means if there are any compulsory selling costs associated with the sales transaction, so I have to incur that selling cost in order to make the sales transaction happen. I have to deduct that compulsory selling cost from the potential sales proceeds that I can receive for that item in order to derive at a net realizable value. Now let me give you an example. You know these huge dump trucks that you sometimes see, they are traveling these abnormal loads on the roads. It is huge. It is absolutely huge. It's been used by the mines and big factories like Acela Metal, those kind of things. But mostly by the mines, they use that huge dump trucks. You cannot travel with that dump truck on the road. So what they do is the components of the dump trucks, they actually transfer to the premises of the customer, and then they will maybe put the whole lot together at the premises. So what all they would just put the whole dump truck on an abnormal vehicle, and they transfer the whole dump truck to the premises of the customer. Now, if they don't deliver that huge dump truck at the customer's premises, the customer can't buy this truck because how is he going to get the truck on his premises? So it is a compulsory selling cost. The company who's selling that dump truck, Cat or Bell or whoever, who's selling that dump truck, they have to pay for the delivery of this item that they're going to sell to the customer in order to make the sales transaction happen. So those delivery costs, that cost of transferring this huge dump truck on the abnormal vehicle from the supplier, Cat or Bell or whoever, up where the customer is residing, that traveling cost of the abnormal load, that is a compulsory selling cost that Cat or Bell have to incur in order to make the sales transaction happen. So net realizable value would then be, what can I get for the dump truck if I sell it tomorrow? That's the realizable value. But the net realizable value says, well, take that sales value that I can get for the dump truck and let's subtract from that sales value, what is this cost of delivering this vehicle at the premises of the customer? And that then is my net realizable value. So at year end, we have to do a comparison between the cost price of an item and the net realizable value of the item. If we go back here, we said at what value should we show inventory in our statement of financial position? At the lower of cost or net realizable value. So going back to this one then, let's say that the total cost price of our inventory items was 100,000 Rand. Next year we will be able to sell that same stock for argument's sake 105,000 Rand, but we have to incur 10,000 Rand of compulsory selling costs. So the net realizable value is then going to be 95,000 Rand. Which one is then the lower? Cost price of 100,000 or net realizable value of 95,000? Obviously the net realizable value. At what value is my inventory in my books? At 100,000 Rand. What do I need to make that inventory? I need to make it 95,000 Rand. Now, inventory is an asset item. An asset's got a debit balance. So if the debit balance is 100,000 and I want that debit balance to be 95,000, what do I have to do? I have to credit my inventory account with 5,000 Rand. And I'm going to debit a net realizable value adjustment account, which is going to be an expense account, with the 5,000 Rand. So we say if the estimated net realizable value is lower than the cost price of inventory, the fair value concept determines that the valuation should occur at net realizable value. Let's have a look at an example. Let's say the cost price of inventory is 25,000, the NRV is 20,000, so we're going to write off 5,000. And here I've said that to you, we're going to debit the expense account, NRV write-down account, or expense account 5,000, and we're going to credit inventory of 5,000. Now, this is a trading inventory item, and because it's a trading inventory item, at year end, we're going to sit with this expense account, NRV account, with a debit balance of 5,000 Rand. What do we do with that? Now, everything that's got to do with our trading activities is, and the write-offs that we're going to do on our trading inventory should be reflected at the end of the day in our cost of sales amount. So that at the end of the year, we're going to transfer this 5,000 Rand to cost of sales. So we're going to credit this account and debit cost of sales with that 5,000 Rand. Now, according to IS2, we have some choices. It says you may apply the NRV rule to each individual item in inventory. Now, guys, that is very much possible if I am, for instance, a motor dealer. I've got 10 cars on my floor, 15 cars on my floor. I go to them one by one and says, okay, your cost price was R1 million, your NRV is 1.1 million Rand. Your cost price was 800,000, your NRV is 700,000. Oopsie, we have to write down NRV on this specific vehicle. But if I have 5,000 items in stock, it is physically impossible to go to each and every individual item and determine what is your cost price, what is your NRV, what is your cost price, what is your NRV. And then IS2 says, then you go to the classification of inventory. So what is the classification of inventory? If it's a retail environment, we will go to trading inventory. We will look at trading inventory as a total, what is the cost price, in total, what is the NRV, and then we determine whether a write-down is necessary or not. We will look at consumable stock, that is things like stationery, fuel, things like that. And we're going to say, okay, this was the cost price, that is the NRV, do we need an adjustment, yes or no? If we are a manufacturing department or a company, we will have raw material, work in process, finished goods, consumable inventory. So for each one of those classes, we will then perform the NRV test. So raw material, we're going to have a look, what was the cost, NRV. Work in process, cost, NRV. Finished goods, cost, NRV. And again, consumable stock, cost, and NRV. Very important is that an entity can have two types of inventory systems. And accounting-wise, there are ramifications and consequences depending on what inventory system a company is using. What is a perpetual inventory system? A perpetual inventory system says we are updating our inventory records with each and every transaction that takes place. So if I have inventory item A, I will record religiously in date format all the sales transactions and all the purchases transactions on that inventory. So I will have a detailed inventory record that will reflect at all times how many items did I purchase, how many items did I sell, how many items do I have on hand, and what is the cost of those items purchased, sold, and on hand at the end of the day. That is perpetual. So in my general ledger, I will have an inventory account that is updated with each and every transaction that takes place. So it will start with opening inventory. All my purchases and purchase-related costs will be recorded in my inventory account. And at any time, all my sales transactions will be recorded in my inventory account. So the cost price of goods sold will be credited against my inventory account and debited against my cost of sales at the date when a sales transaction takes place. So with every sales transaction that takes place, I have to make a corresponding entry which will be between my inventory account and my cost of sales account to account for the cost price of goods sold. The alternative system is the periodic inventory system, and this is definitely not a preferable system because the checks and balances surrounding the system is extremely poor. A periodic inventory system says I've got an inventory account and I will only update the value of my inventory account, i.e. the balance lying there, when I do a stock take. So if I do a stock take twice a year, each time that I'm going to perform a stock take, I'm going to see what is the physical stock on hand. So I'm going to count. I've got 5 of this, 10 of that, 12 of that. And then I'm going to award a value to those items that I have on hand. And then I will calculate what's the total value of inventory on hand, and I'm going to update my inventory account in order to reflect that value. So only with a periodic inventory count, I'm going to update my inventory account. Now what do I do in the meantime? When I have purchases of inventory items, I will record all those purchases of inventory items in my purchases account. So I will have a separate purchases account. All my inventory or purchase-related costs like freight charges, import duties, delivery costs, all those purchase-related costs, for each and every one of them, I will have a separate general ledger account in which I'm going to accumulate all these costs for the year. Now, what happens about cost of sales? Do I have a cost of sales account then? No, because for sales transactions, I only pass one transaction, and that's a sales transaction. I will debit bank and credit sales, or debit debtors and credit sales. So during the course of the financial year, I haven't got a clue what my cost of sales was. And at the end of the financial year, cost of sales becomes a calculation. Now, what do we mean by that? At year end, we're going to transfer our opening inventory balance to a newly created cost of sales account. So only at year end, we're going to open up a cost of sales account. We're going to transfer our opening balance of our inventory, which is long time ago. The opening balance could be the beginning of the financial year's balance. So we're going to credit our inventory account and we're going to debit our cost of sales account. And then we're going to run through our trial balance, and all our purchase-related account balances are going to be transferred to the cost of sales account. So we will credit purchases, debit cost of sale. We will credit freight charges on purchases, we will debit cost of sales. We will credit import duties, we will debit cost of sales. We will credit transfer costs, we will debit cost of sales. So we're going to accumulate then all those individual costs incurred right through the year in the cost of sales account. Then remember, at this stage, our inventory doesn't have any balances because we've transferred the balance out to the cost of sales account. Now we conduct an inventory count at year end. We're going to assign a value to that counted items, and that value needs to be brought into our books. So now we're going to debit our inventory account, which will be equal to our closing inventory, and we're going to credit cost of sales with that same amount. So what is cost of sales now actually? It's opening inventory plus purchases plus purchase-related cost less closing inventory, and that will give us our cost of sales amount in the income statement as at the end of the year. Now, we say that the perpetual inventory system, there we're going to update our inventory records as we go along. So with a sales transaction, we will debit cost of sales and we will credit inventory. So you can see clearly that we will have a cost of sales account right through the year in our books. Periodic inventory system, we're going to put that into separate accounts. So we will have a separate account for purchases and for each and every purchase related cost. And at the end of the year, all those accounts will be transferred to a newly created cost of sales account. So cost of sales again, opening inventory plus purchases plus purchase related cost equals closing inventory. Right. Just going back to this one here is what do we do if there's inventory losses? Now in a periodic inventory system, will you know whether you have an inventory loss? No guys, you won't know. Because why not? I only count stuff, I put a value against that stock that I was counted and I put that in my books. I haven't got a clue. Should I have 5 items of item B on my floor or 10 items? Because I have nothing to compare the number of items on hand to. Where in a perpetual inventory system, because I update my inventory records on a continuous basis, I will have an inventory record that shows me I should have 10 items A on the floor. And when I do the physical stock count and I only have 8 items A on the floor, I can clearly see that 2 items have disappeared in the thin air. So therefore, I've got an inventory loss of 2 items at whatever value those items were recorded at. And that I have to adjust my inventory record with. So in a perpetual inventory system, number 1, I can determine whether I had inventory losses. Number 2, I can determine the value of inventory losses. And number 3, I have to record the inventory loss in my books by crediting my inventory account and debiting the inventory loss account. Now that inventory loss account eventually is going to be transferred to my cost of sales because it's got everything to do with cost of sales. The next thing that we have to do is to see how are we going to determine the cost price of an inventory item. Now there are certain cost formulas that we can apply. We have one of 3 choices in this country. We can either apply first in, first out, or we can apply the weighted average cost method, or we can apply the specific identification method. Now, what does that mean in plain simple English? That means if we buy an inventory item, we can accept that those items that we bought first will be the items that we're going to sell first. So, as things are coming in, it will accumulate, but when I sell, I start at the top and those items will be sold first. So first in, first out. Items bought first is going to be sold firstly as well. What is the impact of that on inventory? That means at the end of the year, and I still have some of those items on hand. At what cost will I have to reflect those items? Guys, at the latest purchase cost. Why? Because the previous items at the older purchase cost has already been sold. So with FIFO, my inventory is actually valued at the latest inventory costs. Now the weighted average method says, well, I want to see what is an average price for an item. So cost of sales will be based on an average price for those items sold, and our closing inventory will again be valued at an average price of those items on hand at year end. Specific identification says I have 5 items on hand. I have a Maserati, I have a Ferrari, I have a Porsche, I have 2 more Lamborghinis on my floor. So there's my 5 vehicles, and I can tell you exactly the Porsche costed me so much, the Lamborghinis costed so much, the Ferrari costed so much. So I can identify specifically my items on hand, and I can assign an actual cost, purchase cost to each and every one of them, and I'm going to value those 5 items which I have on year end at the exact purchase cost in my books. Let's explain this valuation method for you by ways of an example. Let's do first in, first out first. Let's say I buy 10 apples at 1 rand each. Then I sell 4 apples at 3 rand each. I buy 5 apples at 2 rand each, and then I sell 7 apples at 4 rand each. Let's assume we're working with a perpetual inventory system where we're going to update our inventory record with each and every transaction that takes place. So the purpose of this exercise is to determine how many apples do I have left at year end and what is the value of those apples. So the first transaction was I buy 10 apples at 10 rand. So once I have bought those apples, how much do I have on hand? 10 apples at 1 rand. Then the second transaction was I sold 4 of the apples. Now please don't get confused. I want to go back. We sold the apples at 3 rand each, but when we work with a stock record, and that is what we're busy with because we want to know how many apples do we have left at the end and what is the cost of those apples. So when we work with a stock record, we cannot work with selling prices. Why not? Because inventory is recorded at cost price. So if we sold some of those apples, what would have been our sales amount here? Our sales amount would have been 12 rand. So how would we have recorded that 12 rand? We would debited bank 12 rand and we would have credited sales 12 rand. Nothing to do with inventory. Now we have to update our inventory record. We have sold 4 apples. So we no longer have 10 apples which costed us 1 rand. How much apples do we have now? We've got now 6 apples that costed us 1 rand each. So at the end of the day, we have 6 apples which costed 1 rand, so the value of our inventory on hand is 6 rand. What was our cost of sales? Our cost of sales was 4 rand. I sold 4 apples which costed me 1 rand. So the cost price of the apples sold was in total 4 rand. What was the sales? 12 rand. I sold it at 3 rand. What is the cost of sales? 4 rand. How much profit did I make on this transaction? 12 less 4 equals 8 rand. Good. Then I buy another 5 apples, and this time I paid 2 rand for an apple. So I paid out 10 rand for these 5 apples. First in, first out says how many apples do I have in hand now? Well, I still have those 6 apples which costed me 1 rand, and that equals 6 rand. And now I have a second batch, 5 apples which costed me 2 rand. So that in total costed 10 rand. So what is the value of our closing inventory at this stage? 16 rand. How many apples? 11 apples. Right, now we go and we sold 7 apples. Now we said first in, first out, we have to sell that batch first. So 6 apples at 1 rand will be sold first. We sold 7 apples in total, so that means that we must have sold one of these apples as well, and that costed 2 rand an apple. So 1 apple at 2 rand, so that in total is 2 rand. What is the sales proceeds? Let's just go back. On this sales transaction, we sold 7 apples at 4 Rand each. So we have the sales debited bank with 28 Rand, credited sales, the sales account with 28 Rand. What was the cost of sales? Well, the cost of sales was 8 Rand. So how much profit did we make on the second transaction? 28 less 8 equals 20 Rand. How many apples do we still have on hand after this sales transaction? Well, we don't have that batch anymore. There we've sold one of them, so we still have 4 apples out of that batch on hand at 2 Rand. So that gives us a total of 8 Rand. So the cost price of goods sold is here, where we've issued that, where we've used it. And at what cost did we use it? At the original purchase cost. How many apples? What is going to be reflected in our statement of financial position? 8 Rand at the end of this period. How many apples do we have on hand? 4 apples. What is different then in a periodic inventory system? Well, in a periodic inventory system, we had in total, let's just go back, in total, how many apples did we have available to sell? Well, we had 10 and we bought another 5. So we had 15 apples in total to sell. What was the price of these assets, of these apples that we could have sold? Well, 10 Rand plus 10 Rand, that gives us then 20 Rand. So 10 Rand and 20. 10 Rand is 20 Rand. So we have sold 11 apples in total. So therefore, those 10 apples we've sold first, which was equal to 10 Rand. So we've sold 11 apples in total, so those 10 we must have sold, and we must have sold one of that batch as well at 2 Rand. So none of the 10 is still on hand at year end, but at the end of the year, still 4 of those apples are still on hand. And what was the cost of that batch? 2 Rand. So our closing inventory would have been 8 Rand. Let's look at the weighted average method. Now, the weighted average method says, again, I have to update my inventory record if I'm working on the perpetual inventory system each and every time that a purchase or sales transaction takes place. It says, and each and every time that a purchase transaction takes place, it will change my weighted average cost. A sales transaction will always take place at the latest weighted average cost. Now let's take the same example. We bought 10 apples at 1 Rand and that gives us 10 Rand. So we start off with the 10 apples at 1 Rand, which gave us 10 Rand. Then we've sold 4 apples. Now what is the average cost of those 10 apples? Only 1 Rand. So the cost of sales, so the first transaction is 4 Rand in total, 1 Rand multiplied by 4. So what do we have left? 6 apples at 1 Rand. And then we said our weighted average cost changes with every purchase transaction. So then we bought 5 apples at 2 Rand, which costed us 10 Rand. Now, how many apples do we have on hand? We had 6 apples. We bought another 5 apples. So we have in total 11 apples. What did those 11 apples costed us in total? It costed us 6 Rand plus 10 Rand. So it costed us 16 Rand. So in total, that costed us 16 Rand for how many apples? For 11 apples. So what was our weighted average cost per apple? 1 Rand 45. How many apples do we have on hand at this point of time? 11 apples. What is the weighted average cost per apple? 1 Rand 45. What is the value of closing inventory at this point of time? 16 Rand. 11 apples multiplied by 1 Rand 45, which gives us 16 Rand. Now we've sold 7 apples at the latest weighted average cost. What was the weighted average cost? 1 Rand 45. So our cost of sales in this instance is then 7 times 1 Rand 45, which gives us 10 Rand and 10 cents. How many apples do we have left? 11 less 7. We have 4 apples left at what? At the latest weighted average cost of 1 Rand 45. So that will give us a closing inventory of 5 Rand 18. Under the first in, first out method, our closing inventory was R8. Under the weighted average method, our closing inventory equals R5.80. Now work out the difference percentage-wise and you will see it's a huge difference. And that on 10 apples, 4 apples or 5 apples. Now just imagine what impact does this different methodology in valuation methods have on the closing inventory value of entities amongst each other. So guys, IS2 says once I have adopted a valuation method, I am not allowed to chop and change. So if I've chosen first in, first out, I must apply first in, first out every year. If I've chosen the weighted average cost method, I have to apply the weighted average cost method every year. Why? What is the impact of inventory figures on my statement of profit and loss? What is cost of sales? Opening inventory plus purchases less closing inventory. So can you see that if I want to manipulate my profits, I must just manipulate my closing inventory balance? Because if I manipulate my closing inventory balance either up or down as I want, I'm going to get either a higher cost of sales figure. When will it be a higher cost of sales figure? If my closing inventory is less. If my cost of sales figure is higher, what's going to happen to my gross profit figure? It's going to be less. So if I want to make less profits, what am I going to do? I'm going to come in with a lower inventory figure. If I want to make more profits, what do I have to do with my closing inventory? I must actually pump it up to a higher figure. So what is happening then? Cost of sales is then going to, the bigger closing inventory is, the lower cost of sales is going to be, the lower cost of sales is going to be, the higher gross profit and net profit is going to be. So can you see why inventory is such an important figure? Because if I want to manipulate profits, that's where I do that. And that's what you're not supposed to do. So when you're an auditor, you spend a hell of a lot of time looking at inventory values. Because if a company wants to be naughty, that is exactly the place where it's going to be naughty. Because he can manipulate his profits in that figure. How are we going to apply the weighted average method in a periodic inventory system? Well, we said we had 10 apples, which we bought at R1, and we had bought 5 apples at R2. There must be another 0 there. So in total, we had 15 apples at R20. So what is the weighted average cost of these apples that we had available to sell during the year? How many apples could we sell? We could sell 15 apples. What was the cost price of those apples? R20. So what is the weighted average cost then? R20 divided by the 15 apples, which gives us R1.33 per apple. How many apples did we sell? We sold 11 apples. At what? At R1.33. That is our cost of sales. What is our closing inventory? 4 apples. At what? At R1.33. So there's our closing inventory, R5.32. Can you see that each and every time our closing inventory figure and our cost of sales figure differs, whether I'm using periodic or perpetual, whether I'm using first in, first out, periodic or perpetual, or weighted average cost, periodic or perpetual. So inventory, guys, is a very important and dangerous place where you have to watch out. The last thing that I just want to touch on is profit margins. Now, when a company has bought an inventory item or manufactured an inventory item for that matter, but let's focus now on retail. Let's say he bought an inventory item. He has to determine at what price is he going to sell that inventory item. So if you look at some of the inventory accounting packages, you can either apply just a percentage. It says for each and every item that I'm going to buy, please add 20% to the cost price of that item and automatically determine the selling price of what that item should be. So he just add a profit percentage to the cost of an item in order to determine the selling price. Now that is nice for calculation purposes and for us to asking nice questions for you guys. What do we call that profit if it's based on cost? That is the margin, the profit margin that we add to the cost price of an item in order to derive at the selling price of an item. Let's do a little calculation. Let's assume that that is the policy of the company to add a 25% profit margin to the cost price of goods in order to determine the selling price. So then in that case, let's say the cost price is 100. If I'm going to add a 25% profit to that cost price, it's 25% of 100 equals 25. So that means that the selling price of this item will be 125. So if I ask you or tell you that the profit based on the cost price of an item is 25%, you can clearly see it's 25 divided by 100. In order to make this equation balance, it means that the selling price must have been 125. What is the gross profit percentage in this same example? What is gross profit percentage? That is profit divided by selling price. So if the gross profit percentage in this case, the profit divided by the sales is 25 divided by 125, 25 divided by 125, and that equals 20%. So if you are in doubt at all, and we start working with profit margins or profits on selling prices, percentages, then write yourself this little formula. Cost plus profit equals selling price. Let's say there's a special sale and we drop our selling price with 10%. And what is our new selling price then? Well, 125 less 12,5, which is 10% of 125, is then 112.5. What is cost? Guys, if I bought the item at 100 Rand, I cannot change it. I paid 100 Rand. So what changed? My profit percentage has changed. So you can see that we can work back. If I have the profit percentages, I can work either back to the cost price of an item or I can work to the selling price of an item. So let's say our sales price is 500,000. Our gross profit percentage on the selling price is 30%. So what is our cost of sales? So we work it, cost plus profit equals selling price. Cost plus profit equals selling price. Now that 30% is on the selling price. So then we make our selling price 100. Our profit is 30. And that means if we want to balance this equation, what is the cost price? The cost price must then be 70. Let's take this one for instance. We say that, no, the previous one. The cost price, the selling price is 500 Rand. The profit percentage on the cost price now is 30%. So now the cost price is 100. The selling price is going to be 130 because the profit percentage on the cost price is 30. So 30 divided by 100 being 30. And then 100 plus 30 equals 130 in order to get to the selling price. What was the cost price of these goods which was sold for 500 Rand? Well, we sold it for 500 Rand, multiplied then by 100, divided by 130. So the cost price of these goods were 385 Rand. Great. Now, this you know, out of the previous, if we purchase inventory, we will debit inventory, and we are a VAT vendor, and we buy from a VAT vendor, we will add, we will claim the 15 Rand VAT, and we will only capitalize 100 Rand to our inventory account. I'm not going to do that. Let's jump then to disclosure. How are we supposed to disclose inventory in our financial records or in our financial statements? Well, guys, you have to write a note to the financial statements, and in that note, you will give the breakdown of your inventory record. On your statement of financial position under current assets, you will only have one line item, inventory, 96,000 Rand, with a reference to this note number. And in the note, you will break down all the different classes of inventory items with the amounts associated with that. If you have written, let's assume that we've written down, we had an NRV adjustment against finished goods of 5,000 Rand. You will show finished goods here after the NRV adjustment has already been deducted. You also have to write an accounting policy note because the reader of the financial statement needs to know exactly what is the accounting policy applied by the entity. So the accounting policy will be that inventory is valued at the low of cost or net realizable value. You have to tell them what is net realizable value. Net realizable value is the expected selling proceeds less any compulsory selling costs that we expect to pay and to receive. And then you have to tell them that what is the valuation method that is applicable. Is that first in, first out, weighted average cost, or is that equal to, I'm not going to go through this. You can write read that in your own way. So you have to write in accounting policy note, just once more, what is the valuation method. You have to say inventory is reflected at the lower of cost or net realizable value. You have to say what is the valuation method that you apply in order to value inventory. First in, first out, weighted average cost, or weighted average.